Hey guys, this is George David with George David Investing. In today's video, we're going to be talking about something that everyone knows that is going on, and also everyone is subconsciously also bracing themselves for, and that is the housing bubble and the subsequent possible housing bubble crash. So let's talk about it. Let's understand where we are in the housing cycle right now, and where we're going in the next 6, 12, 24 months, and what the catalysts are. Now, in terms of the housing bubble, what we're seeing is a screaming of prices upwards. There are some metro areas that are really, really hot. Think about Austin, Texas. Think about Orlando, Florida, Atlanta, Georgia, Nashville, Tennessee, the greater Washington, D.C. metro area, where those housing prices versus last year in the aggregate have gone up 25-30%. This is why in some places like on the news, you can see people saying that they're getting 80 offers for a house that's about $400K. It's actually selling for about $615K. And the offer that won out had no contingencies and was offered at 10% above best offers. So the housing bubble, there's a couple factors that contributed to it. And then I'll talk about what this means for you, whether you should buy, sell, or wait with houses. And of course, what actually makes sense if you're looking at real estate as an investment play, what actually probably makes more sense in terms of stocks and stuff like that. So the thing is, when you take a look at everything, the housing prices are a combination of people being in lockdown, also wanting to move from crowded urban cities to suburbs where they have a little bit more land. It's also the telecommuting that became more mainstream when COVID happened. So, and then there's that mass exodus from states like California, Illinois, New York. Now, the interesting thing here is there are some signs that the housing bubble is starting to plateau and burst. Now, let's take a little bit of a dive back into 2006 when the housing bubble peaked in most locations. So back in the first housing bubble in the mid-2000s, we started seeing market areas start going away first. And there's a common denominator there that can translate over into what we're experiencing now. And that is the metropolitan areas that started to peak first, such as the Washington, D.C. metro area back in 2006, some of the other ones like Las Vegas, versus a Florida that came a little bit later. Their common denominator out of all of that was that they were not driven by mass migration in. Okay, so what am I saying there? Florida has a very strong positive growth rate. So the market peaked later because there was still that sheer level of demand. Whereas Las Vegas, yes, it was growing and stuff like that, but there just wasn't that sheer demand. It wasn't some kind of economic powerhouse. It didn't have that many people, right? So that market got saturated of how many people would want to afford a starter home at $600K. There's not as many people as a very, very populated, economically booming area such as the Miami metropolitan area. Okay. So understanding that, we can understand how there are certain things now going on where there are signs of the market slowing down. And that's coming in those economically depressed areas or are going through population decline, such as in Canada, we see this in downtown Toronto. The downtown Toronto market was screaming upwards. Now it has stalled out. Housing prices are starting to stall. Why is that? Because a lot of the population, just like in Toronto, but also the downtown Chicago area, are trying to move to the suburbs to get more land. Illinois, downtown Toronto, Detroit, down like New York City proper, those are having negative population growth. So like even the state of California for the first time in history had that, right? So when you look at aggregate demand, the demand is not there to justify prices. So it's going to come in three waves. Let's talk about that, okay? The first one is those major areas that we're talking about have already stalled. And this is due to the fact that the population isn't going there. Just 101 supply demand. The second portion is going to be coming when all those people that are moving to the suburbs, I'm pointing exactly to the New York metro area, where the net gain in population is maybe 1 or 2% over a decade, right? So what I'm saying here is the metropolitan New York area has received an influx of people just coming out of the city. The metro area hasn't really experienced more total demand. So that's going to dry up faster than a major metro area like Austin, Texas, Dallas, Texas, Atlanta, Georgia, Miami, Florida, that is experiencing mass migration. And this is further exacerbated due to the fact that, number one, population is all moving there, but number two, there's no supply as well. So those markets will be screaming upwards. Now, what major metropolitan areas are going to be absolutely slammed? We can actually see clues of that back from the 2000 housing bubble, and that's this. The New York metropolitan area, it's this year. You have this year, if you want to sell your home in those suburbs, you have this year. The market's going to plateau there. And that's due to the fact that you're not seeing mass migration into those areas. All you're seeing is a little bit of an increased demand in your total population base and the population base from the city that's moving out there. If you want to sell your home and you're one of those kind of stagnant metro areas, I'm talking about a New York, a Boston, a Chicago, those kind of areas, then you're on the clock. This year is your chance to sell and go to another area. Now, because of that and because of those places, a 3,000 square foot home, let me give you an example, outside of New York City, let's say in a place like Westchester County, Fairfield County, Connecticut, a 3,000 square foot home before the pandemic was approximately about $750,000. I know there's some local variations, some more desired neighborhoods. In the aggregate, let's say it was about $750,000. Now, all of a sudden, that home is selling for 1.1. All right, that was a massive spike upwards. Yes, they have great schools. Yes, the people in the major New York area are trying to do that. So those prices have skyrocketed. I believe that's about like 30%. We're going to come to a point where you're going to price people out and the demand is not there. We're getting really, really close, okay? And there's other macroeconomic factors that are going to impact those other cities I'll talk about in a moment, like a Dallas, an Atlanta, a South Florida, a little bit differently than the New York metropolitan area. But like I said, so you have just this year, you're going to plateau the market. It just doesn't have more room to go up because it's just pricing people out. How many people can afford the mortgage and the payments and the property taxes and all of that on a house that's 1.1 when you're making $200K total as a household income and you have kids and all of those expenses? It's just not financially feasible, and we're really, really close there. If you're already in one of those major metropolitan cities, you're already experiencing stagnation of prices, and it's going to go down. Now, the prices went up about 30% in those major metro areas. It's going to crash big time, and that's because there's not going to be demand. All of a sudden, you're having inflation in prices, and basically, people are going to start like foreclosing because a lot of people are just trying to throw every single cent. They're not necessarily holistically financially planning. They're just saying, oh, we just want to do everything possible to be able to buy this house. They're not planning for it. This is going to cause a lot of systemic issues in terms of budgeting. And that's really going to impact the economy as well, because another person's spending is not going to be coming in terms of entertainment, goods, services. This causes a whole host of problems. So that area, if you wait, let's say this, if you live in a major metropolitan area like New York and you want to buy a house out there, then you want to wait maybe 2 or 3 years, because then those prices are going to crash again. And in the mid 2000s, these were the metro areas that got absolutely smacked when prices collapsed. So the major metropolitan areas like New York, that house that went from $750 before COVID to $1.1 million will drop down to probably about $800K. Again, $700K, maybe in the worst areas. Maybe there's going to be a lot more distressed inventories, some more foreclosures. If you're there, you want to wait to buy, okay? And if you want to sell, you need to get out of there as soon as possible. Now, the tier 2 cities, which are the cities that are growing, but they're not growing to the rate as maybe a Salt Lake City, a Denver, a Dallas, an Austin, a South Florida, and Atlanta. I'm going to say cities like kind of like Atlanta, not Atlanta, Georgia, the major metropolitan areas of the Northern Virginia. I'm trying to think of another city, maybe like Indianapolis. Those prices, you're having mass migration, not to the extent that those other final cities that I just talked about. But what you're going to see here is the housing bubble. If you want to sell, you have until next year, especially if your house is a little bit lower. So if your house is below 1 million, which is a little bit more readily accessible and affordable to the masses, then your bubble is going to peak next year, early next year. But this year, you're going to see an increased price. Again, let's use the Washington, D.C. metro area as an example. The prices went for a 3,000 square foot home from about 550, 650K, let's call it 650, up to 850, 900. Now, I think by next year, it'll kind of peak out about 1 million. You don't have as much demand and all that. All of a sudden, at the same time, the Fed might have to intervene with inflation. Remember, inflation is possibly coming in. There's whispers of this. I talked about this in my last video at 5 to 6%. By the way, really quickly, if you like this video, can you please go ahead and smash the like button? Helps grow the channel, helps provide this free content to as many people as possible. Also, don't forget to subscribe to the channel. I try to post a video with a lot of value every single day. Now, going back to what I'm saying is that if you're looking at those cities, you might go up to about 1 million, but with that inflation coming in and those worries about inflation coming in 5, 6%, and that really did the economy in the last time. If the Fed has to intervene, starts bringing up those interest rates, which brings up those artificially low mortgage rates, which is fueling on top of some other factors, this insane housing bubble, then, you're going to start experiencing that in the middle class, because what you're going to have happen in a major metropolitan area like DC is people can't afford that mortgage interest payment that's coming in for a 700K home. So I believe very likely the bubble starts stagnating in 2022, and it's just going to stay there, right? Now, the crash will affect those places too. That home will drop from about 1 million down to 700K. So again, if you want to buy in those areas, just wait, maybe like 2 or 3 years. Now, the final area is a little bit different. And this is an area just like South Florida that when the bubble peaked the first time, the housing bubble in 2000, in the mid 2000s in 2006, this bubble peaked in late 2007. And this is those fast-growing areas that are taking in jobs and transplants from places like the Silicon Valley in California and other very high income places like Illinois and New York. And those are the Texases, the Floridas, the Georgias, Salt Lake City, Denver. Here's the rub with this, okay? And this is more so, I wouldn't even say Salt Lake City. I would say this is this area. When you looked at Dallas, Texas, the last housing bubble, Texas, Florida has a screaming amount of people and a screaming amount of jobs coming in. They have, when that bubble bursts, if you look at Dallas on Fred's, Case-Shiller's numbers, in 2000, the housing bubble went nosedived in like in New York. It nosedived a little bit less than DC, but it didn't really do too much. It pretty much stagnated, went down about like 5, 10%, maybe 10%, a little bit more in those Salt Lake cities that don't have the sheer amount of jobs and people that are moving in, like a Dallas or a Austin or an Atlanta or a South Florida, but it didn't really burst, okay? And that's the same thing here. Now, the housing prices, let's use the Dallas area as an example. A 3,000 square foot middle-class home right now is about 600K, okay? Before COVID, it was about 450, and it is screaming upwards. Now, next year, it's probably going to be about 750. We're not plateauing here. In fact, because of the sheer amount of demand and mortgage rates, you're still not pricing out the market because there's more and more people that are coming in to these areas. So by 2023, when interest rates are going up, the economy is starting to falter, then we're talking about prices starting to stagnate around 800, 850. When the bubble burst around 2023, in totality, we're talking about when I said burst, it's bursting like 20, 30% in the first tier cities that we're talking about. We're going to see the housing prices there probably go down to about 800, 750, and then it will continue upwards due to the long-term demand change of those people and companies that are moving en masse to states and metro areas like Texas, Austin, Dallas, South Florida, Denver. Denver being a little bit less jobs moving there. So you have to look at that. You have to take that into consideration. So for those markets, basically what I'm saying is you need to get in. If you want to buy, you got to get in now because the prices are going to continue to go up. And if you want to sell, you can definitely sell down in 2022, because those areas aren't going to be affected. You don't have to rush. Moral of the story is we are in a housing bubble. This housing bubble will burst and it will have some bad consequences. Some of the things that we look for what is going to cause it is first, an increase in interest rates. Increases in oil prices also affects what people can spend as well. And that is something over the long term that will continue to go up. It's just the pattern of the economic cycle. So finally, let me wrap up this video. If you're looking at real estate as an investment, rent is, courtesy of my big Bernedoodle pup snoring like a old man. I apologize for that. Anyways, so what we're talking about, when you're taking a look at investments, if you want to buy real estate, I'm a big proponent in stocks, buy, hold, worth the wait, bigger returns, less stress. There's right time frames for that. We're definitely moving into like economic correction territory, especially when those jumbo tax packages are coming in for both corporate and capital gains taxes. But that's going to be coming up down the road in a little bit. The economy is going to crash. Some of those overvalued stocks, in my opinion, this will be a very, very major economic crash in terms of stock market numbers, right? We will see probably 40, 50% sell-offs, especially in more overvalued tech-heavy areas like the NASDAQ, ARK, Kathy Wood, if you like her, those companies are really, really going to feel that. Doesn't mean that they're bad companies. It just means in the short term, you'll be a lot of bleeding. So you don't want to buy irrationally at the top. You want to buy when those good dips come in, those statistically significant dips. So again, real estate, the market's there. It's going to burst. If you want to buy a house or sell, follow those rules I just talked about. And if you're looking to invest, make sure you do that at the right time frames. We're basically laying the ground for, I know back in the 2010s, we had a nice economic cycle that went forward just for 10 years. Same thing with the 90s. This, on the other hand, is a little bit different. We're pretty much setting the gears in motion to a recession, a stock market crash. At some point, most likely right now, it looks like it's going to be around the 2023 timeframe. And no, I'm not a psychic. This is just basically looking at A plus B equals C in the market and those kind of impacts as well. All right, guys, so this wraps up the video about housing bubbles. I'll have another great value-packed video. So again, if you haven't already, smash the like button, subscribe to the channel. I try to post a value-packed video every single day. All right, guys, stay educated about the market, make your moves if you're trying to buy or sell, and I'll see you guys on the next video. Have a great one.